the SH9T, the swing today was absolutely insane. I went from essentially in the trading portfolio all in on calls and CPI coming in way better than expected and printing to going puts and then going, we're printing again. It was insane. This is absolutely insane. The question now is, what is next? Because the emotional roller coaster that happened today was... First, I'm going to give you what the educated masses on X think the answer is. The educated answer on X is, but Kevin, this is just a rotation from the big stocks into the little stocks. You can't fault people for thinking that. In fact, if you jump into Webull here, you press market cap. Oh, look at that. Everything, at least on my watch list, over a $240 billion market cap, full on red. Everything, if I flip market cap to the small side, so all these like micro and small caps, lot of green. Lots and lots of green. And it starts getting more Christmas-like in red as you get to the larger market caps. So, is this just a cracking of the egg? Is this the sign that low CPI says you can finally get out of the cash parks, which are your Nvidia, which parks cash and makes a ton of cash, your Apples, your Amazon, your Metas, your Google, your Microsoft? Take your money from those because they've had their run, and then throw it all into small caps, and now the small caps are going to catch up and pop, push the market back up. That way the equal-weighted S&P 500 can finally have a chance to rally again. After all, the S&P 500 weighted by market cap is up 17.75% year to date. The S&P 500 equal weight is up 5.85%. So you would expect these to converge again. In fact, if you zoom out over 5 years, look how close the equal weight and the market cap weighted S&P 500 is. It's usually always sandwiched together. You generally don't get this kind of spread. Now, the mainstream thesis is, Kevin, it's normal. It's a normal pullback. We're going to see the S&P 500 go down a little bit and the equal weight go up. And the IWM, Russell 2000 small caps, that'll move nicely up. So just move your money from Nvidia or some others, or just buy the dip and invest it into the small caps, and everything is going to be okay. After all the comments on X are like, Kevin, it's healthy for the market to pull back. Fine. So now we got the educated comments and theses out of the way on X. Now let's talk about why I believe it's absolutely mission critical that mega caps stabilize within the next 2 days, especially throughout the earnings season. Otherwise, we could have a little poopsie doopsie on our hands. We don't want a poopsie doopsie on our hands. You're going to see why. If mega caps do not stabilize, I believe almost all stocks will probably follow them down. That's because we might potentially go back into an environment of any news is bad news. See, good CPI, sell off. Great CPI, sell off. Bad earnings, sell off. Good earnings, sell off. Great earnings, sell off. I can't guarantee that, but that is a risk. And that's just the tip of the iceberg. See, hindsight analysis is great. You know, in a year from now, we'll be able to look back and go, it's obvious, it was this. But right now, we have to be aware that what happens if everything is going to go into a pre-election sell-off, which you generally expect before the election. Usually, it doesn't happen until September and October. But people already expect the September-October sell-off, so are we just going to have the sell-off before the next quarter's earnings? That is Q2 earnings, which come out, in the first month of Q3. It's possible. This is why, bottom line, there might be an opportunity to pick up some downside protection here. Personally, if we lose momentum on Tesla, I know some people are looking for puts on Tesla. I'm not suggesting that, just saying. I know some people are looking for that. Some people are saying puts on Nvidia. it's very risky to go for these individual targeted stocks. I think a much better strategy, and this is probably where it makes sense to put more dollar dollars if you were looking for protection, would be a call option on SQQQ. That's SQQQ. That is the short NASDAQ 100. See, because if what's happening is indeed just a rotation from mega caps to small caps, then SQQQ should go up. If this is a broader collapse of the market and all news is going to turn into bad news, then SQQQ, well, the QQQ index, should also go down, leading SQQQ to go up. Now, the SQQQs, it's a triple leveraged ETF. It's dangerous, okay? It does 3x whatever the NASDAQ 100 does in the opposite direction. So in other words, if the NASDAQ rebounds 2% tomorrow, you should be down 6% on the SQQQ. And you get options on that too, you could be down a lot more. So this is risky. This isn't personalized advice. I'm just saying, if this is a rotation from big to small, the Qs will go down. So you get calls on short QQQ. If this is a larger sell-off, the Qs will go down. I think the play here is obvious. Qs down. Unless, of course, this was just a little fugazi and we're going to bounce tomorrow after PPI and everything's going to be all happy and roses again. I don't know. Tomorrow's PPI read is expected to come in at 0.1 for the month over month, 0.2 for both the ex-food and energy trade, year over year 2.3, core 2.5. All of those numbers will probably come in low, just like CPI came in low tomorrow, or yesterday. God, this morning. The numbers are not bad. Like, inflation is basically proving to be eventually transitory, which is a good thing. The problem is, how much pain are we going to experience in the market between now and then? And the additional problem is, what happens if prices don't stabilize? Folks, recession. When earnings come into focus and everything goes down after bad earnings, company stocks fall. When company stocks fall, companies tend to start laying off to minimize spending and maximize earnings per share. When they do that, you end up with less consumer spending in an environment where consumers are already spending less. Look at what's happening with Delta Airlines. Did you see Delta Airlines earnings? Delta Airlines earnings, a miss on EPS. They just can't sell flights for as much as they used to be able to sell flights for. This is what American Airlines warned of about a month ago. We already saw this coming. On top, now Delta's arguing it. Delta's down 3.99% today. Their year-to-date up 11%, but from their peak on May 20th, they're down 15%. Then you look at Pepsi, another one that's telling you the consumer is weakening so much that they actually have to reduce prices. You're going into a deflationary environment. McDonald's and all the other staples will probably continue to fall. The only things that probably will actually hold up would be pricing power style stocks because they have the ability to continue to price, but not if everybody gets laid off. And see, that's the next phase of the problem. When things start slowing down at Delta and Pepsi and Walmart and McDonald's or whatever, you end up having to lay off, especially when the stock market's falling. And see, unemployment spikes are typically very sudden. This is why that famous indicator everybody keeps hearing of, called that SOM rule, almost triggering a recession. The SOM rule measures the velocity of job loss. It compares the 12-month moving average to where we are now and the delta between the two. You don't have to understand the mechanics of it. Just know it basically triggers when the rate of job loss is rapid. And see, at first, job loss starts like a little piece of paper on fire. Like, imagine I took this little notepad and a little edge of this piece of paper here and lit it on fire. I could probably sit here with this piece of paper and it on fire 30 seconds, maybe a minute, then I'm gonna drop it. But I'm not gonna drop it. I mean, hopefully I put it out, but I'm not just gonna drop it. See, that would be like the slow burning, right, of unemployment rising. When the trigger goes off, dropping this paper is like it falling into a pool of kerosene is bad, or nitroglycerin. And you don't even need fire to light nitroglycerin. We're not gonna get into that. But anyway, it's just bad. Then GDP plummets and you confirm a recession. Some suggest, again, this is just a rotation, Kevin. Don't worry. Why are you pushing for a crash? I'm not. I do not want a crash. I promise you. I absolutely promise you. It is much better for all of my startups, about 3 of them, for us not to be in a recession. Because remember how I just never really have gotten above an 8 on the bull bear scale again? And I'm kind of like, you know what? I'm just going to make sure I have this little safety net of cash because we got a lot of expenses. We got 7 kids. We got 3 startups. We got to make sure we can put like the prop under if we need to and hold it up, right? These are very, very important things. And we for our personal scenarios, situations, we want to make sure we have many, many, many millions of dollars available even if we go into a recession, so we can just coast for the next 3 or 4 years and get through a recession and recovery if there's a recession. I don't want to do that because it burned my cash. It'd be bad. It'd be a lot of suffering and job loss. It would suck. So I want markets to rapidly recover. I want this sell-off to be a nothing burger. In fact, it could be a glorious buy the dip opportunity. Look, you got an 8% off sell on Tesla. And really we could talk Tesla in a different video, okay? We already knew the robotaxi event was going to be a nothing burger. The problem is now you just sort of like accelerated that concern. I'll talk about that in a separate video though. Jesus Lord. Maybe Elon's selling, somebody says. Anyway. Look, I want a bullish market, but insurance might not be a bad idea here. And we got to look at the reality check. Market valuations have gotten nutty. The put to call ratio is way skewed in favor of calls right now. Like everybody's been YOLOing, and that's probably got to flip. You're probably going to see volatility indices skyrocket. So maybe you go calls on VIX, but deflation is coming. That hurts earnings, and then you're going to see more layoffs. We just literally fully priced in the September rate cut. So we're getting a rate cut in September per the market right now. Let me double check. We are, 0.995 now. Okay, now it's like half a basis point under 1%. It was slightly over 1%, but we've essentially fully priced in a rate cut for September. We have now priced in 1.5 cuts in November, and we've priced in 2.5 cuts for December. And for January, we've priced in a full 3 cuts. So in other words, the market's starting to go, whoa. If this is more than just a rotation, ouch. So how do you play this if you're not sure of the direction? Tomorrow, you line up SQQQ. Just buy 1 share to keep it like in your portfolio and your visibility, okay? The second thing you do is you buy IWM, or just put it at the top of your portfolio. Like you just buy 1 share of those 2 and they'll be sitting there at the top of your portfolio, not personalized financial advice. Then, watch them. If they both start going down, SQQQ, well, SQQ is going to go up, right? Because it's an inverse. But basically, if the NASDAQ 100 starts going down and IWM goes down, recession odds go up. The yield curve is already steepening. Not great, because that's usually painful. So if we get a steepening of the yield curve between the 2s and 10s, and both of those sell off, QQQ, IWM, the more that happens, the more days in a row that happens, the more we are pricing in a recession, which is very bad. Okay? That's it. Now, the last thing that you should really consider is remembering that tomorrow the prices on the courses go up on building your wealth. So if you want to see exactly what positions I'm buying, the strikes I'm buying, what I'm doing, what I'm not doing, when am I flip-flopping, how am I flip-flopping, you want to see me flip-flop live, the place to do it is here. Go to meetkevin.com, sign up, you get lifetime access. So anytime there's like a crisis like this, we spent like an hour and a half live this morning trying to figure out what the hell was going on together as it was happening. And we're still able to take tendies out of some positions because we were live doing it together. Like, again, I'm not here to promise that you can always make money. I absolutely will never promise that. I'm not going to promise if you join here, you make money. But what I will do is I will tell you what I'm doing with my trading account. I will tell you when I'm concerned. I will tell you the research that I have, and then you can do whatever you want with it. You pay one time, you're in forever. It's very simple. Thank you so much. Good luck out there, okay? I'm seriously a little nervous.
not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.